Good afternoon to the doctor and my fellow friend. We are from the Good Egg, and today we are going to have a presentation about the triangular arbitrage. And my name is Julie Wood with my matching number 2035426. Okay, next slide. Let's take a quick preview of the agenda in the presentation, which consists the introduction, basic triangular arbitrage, and example of triangular arbitrage. Okay, next slide. The first is the introductions. Okay, next slide. Arbitrage is the trendy strategy where a trader can choose to buy any stock, commodity, or currency in one market and then immediately sell it in a higher price in another market. And this situation creates a good opportunity for the trader to take advantage of the price differences to gain a rich free profit. And this was the oldest and commonly trendy strategy, and the traders who engage in this strategy are commonly called arbitrageurs. Okay, next slide. Cryptocurrency arbitrage use the same principle of the arbitrage as the cryptocurrency arbitrage practice is carried out using two different crypto exchanges that have the different price. Okay, this practice also requires investors to buy any cryptocurrency on one exchange and then quickly sell them at a higher price on another. However, it is important to be aware of the risk caused by the crypto arbitrage because cryptocurrencies prices are very volatile, therefore affect the outcome of the arbitrage. Okay, next slide. There are three types of the crypto arbitrage, and the first is the spatial arbitrage. Spatial arbitrage involves the trendy virtual currency across the two different exchange platforms, and this means that the investor buy a currency in one market and sell it in another market and to gain the profit. And the only difference is that the exchanges are located in the different regions, and for example, investor can use the spatial arbitrage method to take advantage of the difference in supply and demand for the Bitcoin in the United States and South Korea. And next is the triangular arbitrage, and triangular arbitrage involves taking the three different cryptocurrency and trading the difference between them on one exchange, and investor can earn a profit for them. Encourage pricing of three cryptocurrency based on an exchange, and especially when one of the cryptocurrency is momentarily underpriced on the platform. And for example, traders may trade BTC for the ADA and convert the ADA into the ETH, and then trade the ETH back to the PTC, and the goal is to obtain the more PTC. Okay, last is the deterministic arbitrage. Okay, deterministic arbitrage is the simplest for the arbitrage, and it involves the trader buying and selling a digital asset on two exchanges simultaneously to potential profit for market inefficiency. Okay, for example, a trader identifies arbitraging opportunity on two specific exchanges and buy the asset on the platform with the lower price and sell the asset at a higher price on the second exchange. That is for me. I will pass to the next presenter.
Okay, my name is Chongpoting with metric number 2035421. Now, let's have a look at the basic triangular arbitrage. Next. Triangular arbitrage, also known as cross-currency arbitrage, is the simultaneous buying and selling of these three different currency and taking advantage of exchange rate disparities in the foreign exchange foreign market. It happens when there are different rates within the trading venues. Triangular arbitrage is a risk-free benefit when the quote exchange rate are different from the market cross rate. In reality, the price difference between the exchange rate is tiny, as the nature of foreign currency exchange market limits the price discrepancy between different currency to a few cents or even to a fraction of a cent. Therefore, a transaction must involve a considerable volume of money to make triangular arbitrage to be feasible. Margin trading is frequently used in this trade to amplify the returns. In addition, a trader should also be aware of the transaction fees, as it is possible that excessive transaction costs may erase gain from the price discrepancy. Next. Okay, let's look at the simple example triangular arbitrage transaction. A trader using triangular arbitrage would hold a euro and convert it to the US dollar. Then the dollar are exchanged for pounds, and finally pounds are sold for euros, thus completing the transaction assuming a low volume cost net profit. In this situation, the profit obtained by triangular arbitrage is considered risk-free because securities of foreign currency are bought from a market where it's sold at a cheaper price and immediately sold at a higher price to an available buyer in a market. The fact that the transaction is done swiftly and simultaneously shields the arbitrager from market risk such as exchange rate fluctuation or interest rate. However, the traders that use the triangular arbitrage should quickly perform the transaction in large insight to gain the profit. Next. Okay. So why the triangular arbitrage rarely arise? It is because in the real world, automated platforms make trading more efficient and reduce arbitrage opportunities. Besides, the transaction fees and tax can remove any advantage of inconsistent exchange rate in the foreign exchange market. Additionally, the foreign exchange market is very competitive with many players, such as individual and institutional traders. The competition reduces the inefficiency and improve market functioning. Therefore, the arbitrage opportunity do not last long. It may appear and disappear within a second. So that's all from me. I will pass to next presenter.
Thank you, Carmen. Good afternoon, doctor and everyone. My name is Cassandra Tengpak-Eun. Matrix number is 203661. Now I will be going to share the pros and cons of the crypto triangular arbitrage. Next slide. The significant advantage of triangular arbitrage is the speedy profit. By using crypto trading bot, a trader can quickly gather and automate the interpretations of market data, pricing, technical indicator, and statistic. Therefore, the trader can compare the current highest bid price to the lower ask price to check whether this value overlap and execute the necessary transaction in an instant. Second is a wide range of opportunity. Today, there are numerous crypto exchanges available in the market. In addition, the cryptocurrency market operates fully 24 hours a day, 7 days a week. However, level of liquidity can vary throughout the day. As a result, this gives the trader a wide range of arbitrage opportunity to take advantage of price differences, and traders have the ability to buy and sell without limit. Next slide. Even though triangular arbitrage is a riskless trading opportunity that the trader earns from marginal differences in asset price, but crypto triangle arbitrage has its own set of risks and disadvantages involved. The first is the massive capital requirement. The trader who has the expertise and fund will be able to earn the most from the trading. This is because price difference between the exchange rate are minimal, where that is only fractions of a cent. In order to make a big profit, the trader must have a huge amount of investment. Next is the security. Arbitrage traders have to store chemical on exchange wallet. Hence, they are highly exposed to the security risks associated with the exchange hacking and exit scam. Exit scam refer to the sudden terminations of a company operations and the company cuts away with the trader fund. Furthermore, traders need to consider the know your customer and anti-money laundering regulations before they deal in cross-border arbitrage trading. Next slide. Next, I will share how does the triangular arbitrage work. There are 5 steps involved in the triangular arbitrage. The first step is to identify a triangular arbitrage opportunity. When the stated rate of exchange differ from the cross exchange rate implicit in the market, triangular arbitrage possibility occur. The equation shown in is to calculate the rate of exchange, which is the rate at which one currency would anticipate in the market based on the ratio of two foreign currency different from the currency that is chosen as the base. A is the currency assumed to be the base. The other two foreign currency which are B and C in these equations. Second, once an arbitrage opportunity has been approved, the trader has to determine the difference between the quote and cross rate. Third, the trader will execute the first leg if the differential between quoted and cross rate is sufficient to generate a profit after expense and charge are added. The first leg is the buy operations of the trade. Fourth, the trader need to exchange the second coin for the third. This is called the second leg or the sale of the operations trade. Fifth, the trader will change the third currency back into the base currency, which is also called the third leg. That's all from me. I will pass to the next presenter.
Thank you, Cassandra. So now I will continue the presentations. I'm Ye Yong, and now I'm going to present part 3, which is the example of the triangular arbitrage. So I will imply the quotation into some step to show you how the triangular arbitrage works. So in first step, we need to calculate the exchange rate. So the investor can make the profit when the quoted exchange rate does not equal to the market close exchange rate. So let's take a look at 3 currencies in the 3 market. So in London, there is $1.5 per £1, and in New York, there is 1.2 euro per $1, and in the Amsterdam, there is 2 euro per £1. So next slide. So we are going to calculate the cost rate between the euro and pound using $2 rate that are given to us from banks in London and New York. So let's go ahead with the formula. So we will put in the 1.2 euro per $1 times $1.5 per £1 and get the 1.8 euro per pound. So now we need to see whether there is an opportunity for the investor to make profit. Next slide. So we need to identify the triangular arbitrage opportunity with compare the currency in the Amsterdam with the new currency that we calculate in the slide before. So Amsterdam is the 2 euro per £1, and the new currency is 1.8 euro per pound. So there is an opportunity to the investor. So we can see that in Amsterdam, the euro is overvalued, and so the investor can sell out euro in Amsterdam and buy in another market. Next slide. So now we suppose an investor that have the $1,000, so he need to sell and buy to make more profit. So we need to going from pound to euro to maximize the profit. So the sequences we choose is sell and buy in London and go to the Amsterdam, and last is the New York. Next slide. So firstly, we will sell $1,000 in the London and buy pound in 666.7 pound. And second, we will sell out the pound to the euro with the rate 2.0 to buy the 1,333.33 euro. And lastly, we will sell out the euro again to buy back the dollar in $1,111.11. Next slide. So in the last step, we need to calculate how much profit we can get in this triangular arbitrage. So the profit we can calculate by using the new profit, which is the $1,111.11 minus the initial investment $1,000. So we will find out the arbitrage profit is $111.11, which is the profit investor can gain across these transactions. That's all for me. I will pass to the next presenter.
Hi, Doctor and everyone. My name is Chong Sofa. My metric number is 204089. I will continue the last presentation about the example of case study on triangular arbitrage. As my partner mentioned, that the triangular arbitrage is exchange an amount at one rate, which Ringgit Malaysia over USD, convert it again to Ringgit Malaysia over Singapore dollar, convert it financial back to original rate USD over Singapore dollar at low transaction cost to take the profit. For the contingency currency, which the profit with less risk when they make most of the price digital assets slightly price discrimination across the multiple market. One of the case study example said that which a trader has 2 million in hand and he planned to sell the dollar for euro, which at euro over USD equal to 0.9072. Then sell the euro for the pound at euro over pound sterling 1.4521, and finally sell pound for dollar at USD over pound at 1.6032. And for this diagram, we show that when a trader used 2 million in hand and perform transaction to sell the dollar for Europe, which at Europe over USD 0.9072, the first transaction is 2 million USD multiplied with 0.9072, that the trader will get 1,814,400 euro. Then the trader used the euro for pound at euro over pound sterling, which 1.4521. The second transaction will happen, which 1,814,400 over 1.4521 euro equal to 1,249,521 pound sterling. Finally, the last transaction is trader use pound to get the dollar again at USD over pound sterling at 1.6032. The last transaction will cost around 2,003,200 USD. Hence, for the previous example, we can see that the trader to use the discrepancy in the price quotation of the three currency dollar, euro, and pound sterling to turn his initial investment, which is the profit will gain around 3,200 USD, which the 2,003,200 minus with 2 million. The profit will be reduced if it involves transaction cost. The second example is about the order book data with ask and bid price and amount. This shows that there will be an ask and bid price for an order book. For example, it starts with the starting asset USD buy on the trade pair A, then sell USD and buy BTC, buy on the pair B, then sell at the BTC and buy LTC, and sell on the pair C, then sell LTC and buy back USD. The transaction fees in this example is 0.2%. The trader finally make profit from changing the price of asset across multiple exchange. That's all for our presentation. Thank you.